of the newsletter, Pete, was making probabilities out of prices. And maybe you can talk to this a little bit before we dive in to some of the numbers. But I talk about how options traders kind of look down at us futures traders a lot of times, Pete, because they
draggers.
They like to think that we're a bunch of idiots, that it's like, oh, it's all these 50-50 bets and you guys don't have any edge and there's no Greeks and there are no this or that. But I mean, whether you're trading, equity futures, interest rate futures, commodity futures, or what have you, you still are in your head and on the screen making probabilities out of these prices, right? Like you're still creating edge. Maybe you can give an example of that or talk a little bit about taking a price like crude oil today being down $2.50 and thinking about it in terms of a probability that it might go in some direction. I mean, this is what you do internally in your brain, right, Pete?
Absolutely. I think that you look just from, years ago, we really didn't have the ability to use probabilities. I mean, they're always out there, but the vast majority of people didn't. And and this was the challenging part, is you took in your mind what had been kind of a dynamic daily range, and you traded that range or were more aggressive at the extremes. Now, the problem is when that range changed, it was adjusting your trading style. You were using either metrics that you never got any trades on because your ranges were too wide, and the trading range the market was giving you was too small, or where it was really problematic is where you were still using, say, a 100-tick range where the actual tradable range was 200. So bringing probabilities into this and taking intuition out is really important in getting an edge. We felt we had an edge on those when we got to those what we felt were extremes, and were able to trade around them. And they were usually exhaustion periods where you could see, the outside market capitulate a little bit, and you saw that capitulation order flow, at least what you determined that to be. Here we're going to use something really that is the next iteration, is the probabilities around, intuitively you had these tools you kind of built up because you were actually, you were a full-time trader in the pit where the markets were being made. And even that, it was an imperfect methodology. Now we're going to talk about taking that intuition and actually making it sound and making it, backing intuition with fact. And that actually will make you, even me, I certainly have an opinion. Honestly, my opinion was the wrong way in crude, but I certainly have an opinion about markets, but I use these tools to be more effective around. It's another important, trades aren't made on one single decision. We always live by the rule, we're not short just because the market can't go any higher. That's not a reason to be involved. But here we're starting to add these tools to cumulatively make a better decision.
Yeah, you raise a lot of great points. And, to draw an analogy to options, it is kind of this idea of like you say, if you're used to trading E-mini S&Ps, right? You've traded them for decades, you could, or at least years here. And you're used to, from back in the day, being like, $20 is a big day in S&Ps. And now in 2021, when we go through periods of when the pandemic news was coming out at the early part of last year, that $20 range is meaningless for you in S&Ps. Or when volatility gets really low, you're not adjusting with the times, similar to option traders, thinking like, VIX having an average price of 20% in VIX, that just tells me cleanly when I should buy volatility and sell volatility. Well, there are years where VIX doesn't get above 15%. So what do you do? Are you just buying volatility? You have to adjust there. That's what IV rank does. And that's what, some of our probabilities that we send out to our community members, like the standard deviation, kind of our futures traders IV rank for all intents and purposes, which is this adjusting look back period that's saying, okay, well, the last 3 months, the range in small stocks futures has been $1. If we get more volatile in the next couple of weeks, that'll adjust out to $1.25, $1.50. And those are our new ranges for trading futures. If we, like we just saw leading up to these last couple of weeks, volatility down huge, our scalping ranges got into 50, 60, 70 cents. it is definitely a great thing that we're promoting these probabilities in futures, but also adjusting them so frequently for our small community members, similar to those IV ranks and everything else. But one thing I wanted to speak to a little bit more is a long-term probability out of prices situation, which is this 2-year Treasury yield. And we talk about this a lot. And actually, Treasury yields in the 2-year getting below 0.2% for the first time in the last couple of weeks here. And this is a situation where also you can make probabilities out of prices, because you have a 2-year below 0.2% right now, kind of pricing right around the 0 to 25 basis points that the Fed is currently at. Now, the Fed has projected for by the end of 2022 and the end of 2023 to be at least off of that 0% by the end of 2023, being maybe 2 or 3 rate hikes off of that 0%. And this market with the 2-year Treasury yield is still at 0, Pete. And I know it's not a perfect relationship, but the Treasury yield for the 2-year is essentially that short-term interest rate, that short-term yield benchmark for about 2 years of duration. And so that if the Fed is projecting rates around 0.3% or even up to 0.7% by 2023, and this 2-year, which has that duration in there, is still at 0, that would make me believe that there's maybe a greater than 50% chance that these 2-year yields lift. Like, that's an instance of creating probabilities out of current prices and projections and historical prices, right?
Absolutely. You make a fantastic point in terms of, this is a great example, I think, of that putting probabilities in your favor. And now, granted, we're down on our 2-year position, but statistically, that trade was put, again, statistically, and we always have to remember this. What we want to do is move the ball off of 50-50. And I've mentioned this before, some of the best firms in the world make millions of dollars on 52-48 just because they're trading so often during the day and so many different products. We like to move that ball a few more percentage points, but that still leaves us the other side of the percentages, which are losses. That's why we always talk about management. In this particular case, so it's a great example. You talk about probabilities and opportunity in a tradable product.
Yeah, and interest rates are always great just because they're so, in my mind, one of the cleanest. Once you get a handle on interest rates and just like what they are, how they move relative to stocks and some other things, it is one of the cleanest markets. Because like with stocks, you and I always get back to this, like you can create some probabilities in your head with stocks. Like I was thinking about it with some of this, some of these COVID fears resurfacing recently, is you look at the S&P or you look at the small stock 75 or whatever. Here we have, I think, some data for the small stock 75. And this is just the daily range, but you look at trying to assign probabilities to the stock market. Right. And I always think about like, where were we at before the pandemic sell-off occurred and how far did we get down there? And we're through those highs of pre-pandemic. And some of these fears are starting to resurface, and you're seeing it in some of the markets. You're seeing it in interest rates. You're seeing it in potentially crude this morning. And the stock market, though, still has a long way to go to those pandemic lows. Now, of course, you hope and I genuinely think we're not going to get back to the worst days there of the pandemic when that news was coming out and everything else. And this is not to say I hope that this stock market sells off because of any of this, but it is a way of like assigning probabilities in your head is like, like the stock market was 20% lower even when pandemic worries weren't as high. We've got this volatility, this fear coming back in, like how much can the market sell off? And now it's cleaner with interest rates because you can literally be like, the Fed is thinking 75 basis points by 2023. The 2-year is at 20 basis points. There's room to grow in there. With the stock market, it's not as clean, but it is something to think about. Now, Pete, Short-term probabilities, we love to use the 68, 95, 99. That is 1, 2, 3 standard deviations. And we actually saw this morning. SM75 was up $1.20 and came all the way back to unchanged. Now, that doesn't always happen, but when you get outside of 1 or 2 or 3 standard deviations, Pete, you're getting a little bit more of that probability in your favor of the market coming back.
Absolutely. I mean, this is the whole, the numbers. This is a clean way to start the discussion of reinforcing intuition. I mean, we have a bias, and whatever that bias is, it's important to use tools to validate it. And here you're absolutely right. We like to use these as very clean metric. And you know what's interesting about this, Frankie, is that this 1, 2, and 3 standard deviation level, while that $1 changes depending on the product, those 68, 95, and 99 percentages never change. So you get these consistent markers of probability wherever you are. Like I said, one of the wonderful things is Frank creates all this tremendous research in the newsletter. That number is different per product, but the consistency around methodology and trade management and what's an extreme is consistent when you use the percentages.
No, that's why it is kind of the standard deviation to me is the great equalizer in futures, the same way that implied volatility is the great equalizer in options. Because the calculation is the same, but I can easily now say, one standard deviation is $1 in stocks. It's 40 cents in yield products. It's 70 cents in the metals. And I can still feel confident, like, okay, it's the 68% probability edge that's in my favor, but I just need to know these different prices depending on the product, and that's where I can trade around. And so you can look at, stocks being up more than $1 today and a reversion play there. And you can look at crude oil, the standard deviation being $1.50, 2 standard deviations being, $2 to $3 almost, which is where we're at right now in crude, and look at that from the other direction. And it takes opportunity in trading futures and it levels them across all asset classes. Now, Pete, speaking of all asset classes, favorite part
of the show.
I tried to fit as many of them in here today. We've got oil, yields, and metals kicking it. This is the segment here on the show where Pete ranks the pairs of the week that I've put together. I'm going to outline them and the opportunities here. And Pete, you can go 1, 2, and 3 in terms of your most favorite. Kicking it off with one. This is the second time we've done this where I've tried to bring you a trade where it's like, this is an interesting way to potentially sell oil and hedge it with the oil stocks. And of course, again, crude oil, a big move lower on the day that I bring it up. But I would contend that this is, if you feel like you and I are always good about this, Pete, where it's like, just because the market is a little bit lower doesn't mean that the opportunity to sell it is completely gone. And the same with just because a market is a little bit higher doesn't mean that I didn't buy the lows, so it's gone, or I didn't sell the highs, so it's gone. And especially when you pair stuff up and you hedge it, it brings that opportunity back a little bit. So
and the pairs trade helps with quote unquote static delta trade location. Now that sounds kind of long-winded, but all that is wherever I'm getting in. And the dynamic of, you could have sold on the way up 72, 73s, and $74 crude oil. And you would have thought each of those was the high. Now that you look back, you can't say, well, I didn't sell the 74s, I can't get them. I mean, if you're going to try that idea of selling them, you're going to be short. You're never you're rarely going to pick that top. So you have to trade the range. Now, unfortunately, I've got some short call spreads, but my scalping, I honestly thought crude was going to hold that higher end and actually push a little bit higher. So it's given ground. But if you're looking at this particular pairs trade, anything in crude above $70 versus the range of 74 to 64 has got to be kind of rich, especially when you're comparing it against the stock piece.
Well, so this is my thing here, right? Is that oil is still holding, even with the down move today, holding on to pre-pandemic levels. Like it's above where it was before that pandemic, well above where I think we were in the 60s. We're still in the 70s now for crude, which once again isn't to say that like, oh, I want crude to go back to zero and I want this pandemic. Of course not. But you've got oil stocks that are significantly lower
Right.
from the highs, from the bounce back of the last several months. And so I like the idea of just selling this oil market and then buying oil stocks against it. And you can do it pretty much on a one-to-one basis, one short SMO, 100 shares of XLE. Or I also like the idea of just selling an XLE put for like $1, somewhere around that 80 cents to $1.20, somewhere in there, and selling the SMO against that like a covered short, just because I think those stocks have to either bounce back or hold in. Crude oil might give some ground if these fears continue, or if the fears dissipate. I think these oil stocks should bounce back a little bit. And crude oil is, I don't know how much more room it has. Like you say, you were confident in the range being $70 to $75. That's not to say that you think it's going to get above 80 or anything like that. So I like that one there, SMO2 XLE. Next one on the board, and this is giving you new lows as we speak. The tub spread, Pete, 30-year bonds to 2-year yields here. The two ends of the spectrum, which was a big no-no for me when I was at the Board of Trade, just because we were trading the big Treasury
they were unforgiving.
Futures.
Yes.
It just too big of products with these small products that are priced in yield. You can do it so much smaller and so much simpler. 1-to-1, 30-year against 2 years. That 30-year has come all the way down. 2 years staying pat. And this is a good one if you have long yield exposure, Pete, to maybe, just kind of scalp around that, buy some 30 years, sell some 2 years, and just look for, $50, $60, and then get right back into those long yield positions that you had to begin with. Next one on the board is metals versus gold miners. I think this is an intriguing way to potentially get long gold and silver here against the gold miners there. Looking at SPRE to GDX, every long contract in SPRE, you could do 2 short call options in GDX. I think that's an interesting play as well. A lot of stuff on the board here, Pete. Why don't you go ahead and rank them?
Absolutely. I got to take the metals. I love that trade.
Okay.
I think that it's just the downside seems to be unchallengeable. If you look at the tape action, we're lower. I mean, we're definitely on the lower end. Silver, think about the mid 30s. We were looking at silver. We're appreciably. It's interesting. We're well above the $14 and $15 silver we sat with for a long time. Yeah. I remember you and I sweating 1375 puts because they kept getting tested. But I think that range is in. I think the GDX side, the premium isn't great, but it's good for a pairs trade. And that's where just going into GDX and building a call spread is very tough right now because the premium isn't on the high end. But when you look at it in terms of a pairs trade, it becomes a very useful tool in cost basis reduction for your futures trade. So I love the SPRE, the 30s versus the 2s. I've already got the long 30s. I get what you're saying, and I'm long the 2. So I would be basically disassembling my 2s, some of them, to put the 30s on. If you're doing it that way, if you have nothing on, this is a great trade. This is the extreme on the board, almost more so than equities. This is the true extreme, the tub spread, the barbells. What I mean by the 2 long ends of the yield curve, 2 years and 30 years. This is the extreme out of anything on the board. So if you're looking for a true extreme statistically in the long term, this is the trade. Is trading those 30s against those 2s. I like that. The SMO XLE, I'm kind of out of whack on my positions, but I think another one that, yes, it's down $2. You've got a 70-cent bounce. If you really like this trade, the 70-cent bounce is you're not selling right below at 70.50 where the market got down to. You got a 70-cent bounce if you want to put it out. Sure, you didn't get the 74s, but the tradable range, again, the XLE helps with that fact that you didn't sell the high end of the range. But I got to go SPRE, I got to go the tub with the extremes, and then the oil trade. But all great trades.
Very cool. Thanks so much for that insight and the ranking here on Monday afternoon. Always a fun time. That is making probabilities out of prices. We are done with small stakes for the day. Pete, thanks so much. He'll be back here with Jamal tomorrow for the leap, but we'll be back in just a second for Splash into Futures. Got a lot of trades for you here. Stuff is heating up on Monday afternoon, so hopefully you got your trade platforms open. Thanks for watching, everybody.